All right, guys. Hope you guys had a good weekend. Pretty much, I'm going to be covering about a lot of different things over this article I've kind of pieced together today. Um, Pretty much just want to go over, a lot of the issues that we're facing. I'm seeing a lot of traders having to deal with this low volume coming in. Not sure how to play it. I'm pretty much going to do a whole breakdown here on trading with a plan and making sure that what to expect and how to adjust to the new market conditions. So the dark secrets of trading. When you look at a price chart, whether it be for a stock, foreign currency pair, or futures, it seems like it should be pretty easy to make money. Often when investors first get started, they focus their attention on the big moves and think, if I'd gotten in there, I could have made a fortune. Adopting such a perspective can lead many people to think day trading is a relatively easy and quick way to riches. Day trading can provide significant income if you know what to work on. However, for many people, the required amount of learning and trading practice prevents them from gaining enough experience to become consistently profitable with their trades. Day trading success rate. Knowing the number of people who are successful versus unsuccessful at day trading will not help you understand why most people fail. It's a challenge to turn a profit through day trading, and although every day trader believes he can make money, about 95% of the people who attempt day trading end up earning a net loss. You can improve your odds of profitable trading by understanding the risks that can lead to losses and getting past the assumption that day trading is easy. The need for a robust method. A primary reason traders lose money is the absence of a solid trading plan and strategy. Simply looking at a chart in hindsight is not an effective way to create an effective, profitable plan. If you develop a robust strategy, it can be used in all market conditions and will inform you when to stay out because conditions are not favorable. An effective strategy helps prepare you to take actions before a profitable opportunity arises, not after. The goal of your strategy is to uncover patterns and trends that point to trading opportunities that could deliver positive returns. You'll need to do research to identify performance factors related to stock or segments of stocks. Without such research, results might largely be determined by chance. Taking time to practice. Many novice traders face the obstacle of not understanding that day trading takes a decent amount of time to learn. Many online trading education sites, books, courses, and other resources discuss some of the more prominent trading misconceptions that beginners may have. Putting in a few hours of research without consistently committing time to day trading won't make someone a successful trader. You'll need to practice day trading while maintaining another job unless you have money set aside to cover your expenses for several months or more. It is highly unlikely for a day trader to produce any income from the practice when they get started. Most day traders don't see their efforts results in enough profits to pay themselves any type of income for at least 6 months to 1 year from their start date. Just kind of giving you a relay, that's pretty much a fact as far as how getting started as a day trader is. A lot of people don't understand how difficult it is, and it takes a lot of trial and error experience to kind of know what you're doing, getting into the rhythm, knowing your style, knowing your plans, your setups, the way you trade. Everybody has a different mindset, a different emotional level, a different tactic as far as how they want to trade the markets. This is just pretty much going on a rough overview of what you're facing as far as starting in. Numerous issues and situations contribute to making the market difficult to gauge and navigate. Taking the time to learn and understand what triggers shifts in trading activity can better prepare you to respond to those changes. Learn to control your financial risk in case you make a wrong conclusion about the direction of a trade. By putting a stop loss on your trade somewhere, this will give you an opportunity to react if the asset price suddenly drops. Think of it as setting a threshold to help mitigate the amount of money you may lose while pursuing trading opportunities. Understand that you cannot always get the exact price you want when trading, especially when market orders. Heavy trading activity might push a price away from your precise target before you can react. You can choose to skip what might still be a good trade or accept the less than ideal market price. Both options will reduce your theatrical profits on the trade. Even if you use limit orders, you may only get filled for part of your order on winning trades. The market runs always before filling the whole order. Before you could end up with full position on your losers, prices moving against you. So unfortunately, you always get your full order. Understand that the market is entirely composed of other people trying to make money or fend off losses, hedgers, people who are very good at trading to look to take advantage of the orders that are placed by inexperienced traders. Veteran traders look for prices they believe allow them to leverage some potential in the assets that others have overlooked, and that will provide a good entry or exit point for them. The personality factor. The individual desires and intentions of day traders can substantially influence the outcomes of their efforts. A bit of success can lead to greedy actions that stray them from an established trading plan. This can include taking action too soon, holding on to a profitable gain too long, or not cutting losses soon enough in a losing trade. These and other scenarios can mean losing out on the profits that might have been claimed. Fear can likewise cause a day trader to hold back too much when an opportunity is in the making. They may also sell in a panic in response to breaking news without taking into account all of the other factors at play. Forming a solid trading strategy has the huge benefits of keeping your focus on your results without being swayed by emotions. Okay. Lately, I've been noticing people having, I know a lot of guys in here have got smaller accounts and they don't know how to ration out the sizes because too big of a size in OTC, especially with low volume right now, is dangerous because you can be stuck with your full amount and it's hard to sell out, hard to scale out because these runs just aren't, hugely strengthened. It's kind of funny as the summer volume comes in. You're dealing with a lot of pump and dump groups, a lot of email promoted plays, fake news, et cetera, to kind of drive some of these lower float plays into getting more attention all of a sudden because there's a lot of people running liquid right now that got cash ready to go in something, but sometimes you've got a lot of people that have got a bunch of cash tied up in stocks that aren't moving at all right now because of the lower volume. And, your whole objective in this mission is to make money on each trade. So I've scaled out dramatically. I mean, I used to hold a fair amount of plays, but I've scaled out to where I'm literally holding probably 5 or so plays right now. And it's very, I've decreased my position sizes. I've narrowed down things a lot because too much money and too many trades is kind of dangerous because they're not going anywhere. They're dead plays. No one's interested in them. The thing is with my trading is I like to get in before the filings drop, before the news drops. Something we got to look at is filings have been dropping on some of these plays, but it's not moving them. It's not creating enough interest for that play for people to want to pursue it. So the whole idea with trading good plays is kind of getting in before that action happens. So a lot of plays are going to be started, like I said, with fake news, with email pumps. You're going to see a ton of that. You're going to see a ton of people posting out tweets about massive price targets. I never try to give a massive price target for any play. I try to alert. It's not safe to put yourself in a mindset that this play is going to gain such massive potential. You got to think realistic. So I'm just going to go over here as far as proper trading sizes. You've got this $3,000 account, which seems like kind of an average number for beginners. I've been noticing around $3,000 to $5,000 to $10,000 as far as a beginner size account. Sometimes as low as $1,000 or $500. But I'm going to go off an example of $3,000. You've got this $3,000 account set up and you're scared of losing money, but still at the same time want huge gains. You have 16 open positions. You're in all these positions because why? You're gambling and you're thinking just one will strike as gold. Your account seems to break even every week or actually loses. You're looking at your $100 investment wondering why it's not $1,000 yet. Step back, look at this for a minute. What's wrong with this picture? No trade plan? Expecting a $100 trade to make 1,000% gains to reach your $1,000 gold strike? I mean, you've got to go into small, fewer positions. You look at 16 positions to a $3,000 account. That's an average of $187 per trade. But I'm going off of $100, investment. You're putting in a tiny bit of money to expect what kind of return. I mean, 100% on that return is $100 minus, the commissions. You probably paid, $7 to buy in and $7 to sell. So you're pulling $14 out of your trade. So now you're left with, what is it? $87 off of 100% run with $100. I mean, it's not a lot. So you're thinking, I don't know where your mind is as far as putting $100 in and expecting to make profitable gains. You can try that, but what if the play only gives you 20%? I mean, that's not even hardly going to cover your commission. No play is guaranteed to give you 100%. So in a $3,000 account, I would probably split that up into $500 a trade, and keep, $500 or $700 or something off to the side as liquid cash, to either help average down one of those trades or to, you see a good day trade coming in from obviously fake news or a pump or some incentive for that play to just shoot up, and you want in to grab some meat of that move and be out that same day. Some of you are on cash accounts, PDT rules. You're on a margin account under 25K, so you've got to kind of ration out your day trades with your liquid money on the side. So while you let some plays, mature, but putting too many open positions, especially with low volume that we're dealing with right now, like I said, is dangerous. I mean, maybe 3-5 out of those plays of 16 plays are actually going to move for the day. Some of those may move. It's kind of doubtful all of them will move. It's thinning out. It's thinning out your potential for that account. Yes, it's adding more risk, putting more money in a trade, but you want to make sure you have a plan for that trade. You don't want to go blindly in the trade, and obviously risking more money, but you're obviously going to get more in line of what you're thinking in your mind of profits. When you see $100 go up 100%, some people might sell at 100%, but others are thinking, it's not enough money. I'm thinking more like $500 or something in my head that I want to get. In order for that play to get you that $500, it's going to have to go up 500%. And we're just not going to be seeing 500% on a daily or normal basis unless something extravagant for some reason randomly comes to your play to cause that. Tons of positions open, putting bets on plays because someone else is in it. Scared of the trading risk, so going too tiny to where no profit potential is made. Commission costs too much to sell right now. So just something to keep in mind. I know you guys got commission, so you're buying. When you're putting in a little bit of amount, your commissions are kind of eating you up, and then they're going to eat you out on the way out, and you're going to be frustrated that you're not making those money. Ask yourself why. Trade with a plan. This isn't gambling. Know the reason behind your plays. Come up with a trading style that works for you. Now, as I was saying here, tons of positions open, putting bets on plays because someone else is in it. That's the most common thing I see with some new people is they're in the play because someone else is in the play. They had no specific plan on the play for themselves to get into that play because they were, excuse me, they were thinking of, the plan around that play. They just bought in it because someone else may have tweeted that they're buying in, or it was an alert I could have posted and they bought into it. I try to pick my alerts at the bottom, as the best entry possible because that's kind of when I'm getting in it. But if that play turns against me for some reason, like dilution on CLKA is an example, I'm going to get out of that play as soon as I can. If it looks to be too strong against me and I'm in at a bad area, some of us got in that play at 0.002, which was great. And it was ideal when it finally went to 6. You sold out. You had your free shares. Obviously, it came back down to 4, came down to 3, and dilution started striking it bad, but you were on your profit because you're riding free shares. So you kind of want to just take your profit off the table. Obviously, it wasn't as great as it was at 6, but at least it wasn't a loss. Because it was a plan. You traded that plan and it worked according to you. Obviously, you can't force the markets to work with you. No market stock is for you. Don't be a follower. Many times I see with new traders, they're asking, what's the next big winner? Why do I keep losing? This shit isn't for me. I keep blowing up my account. Why am I not making any money? I'm tired of losing. That guy promised me 500% gains on that alert. I'm holding this play, but it's not moving. I'm going to sell it. I don't know why I'm holding it. I only bought because he told me to. Gosh, I'm stressing out right now. When's the next big winner? Too many emotions that you're tying up into these plays, and there's no due diligence or personal plan in your mind, like I was just suggesting, that for you to want to get in that play. The biggest thing for me when I first started was creating a plan for every play. Whether it's writing down a rough guideline of what this play needs to meet in order to meet your buy inside your head, your signal to buy it or not to buy it. Not every play is a guaranteed runner. Not every play is going to do whatever, and you've got to judge everything on the best of your abilities according to your plan. And, I didn't create it's kind of funny. I didn't have a plan in my head. I was buying anything that hit my scanner just because I had money loose and I just wanted to buy something because, I've got no skin in the game if I don't buy something, so I'll just buy anything. But you can't do that, especially in OTC. You can't. I mean, you slap the ask, you're asking to sell into the bid on a bad play. That's guaranteed loss right there. Emotions will strike every trader out there. It's how you handle it that makes you a winner in this game. Creating a trading plan is the only way to win at trading. It's not by luck you won a trade 9 out of 10 times. We as traders are not gamblers, are reasons behind our trades. Don't buy because such and such told you to. Learn to take your judgment that fits your plan to know if it is good or bad. Don't have tons of positions, just waiting on the one trade to change your entire account. You have to learn risk versus reward. We're in this to make money. Low volume. We are entering a summer volume. As I can't stress enough, stay liquid. Cash is king. Runners are very limited. And as you can see, your bags or your long plays are still holding or losing volume and interest. Some days they can get no volume. Reason it's time to get out of those. I don't know why I'm holding it plays. Filings drop doesn't seem to move OTC picks much, only strong news. Other factors are fake news with big pumps and dumps. There's obviously money to be made, so be smart, but it's more common during slow volume. Cash is king when you want to get in a day runner. So like I was saying, a lot of these groups are going to be promoting plays in their email alerts. And as I'm looking for these low volumes right now, Tractor just mentioned here at the beginning of the session that, he's looking for low float plays. And that's kind of what I'm trying to focus on more is lower. I mean, low as low float as you can get. It's kind of funny. Some of these trip plays I'm seeing with a 200 and 300 million, share float, is moving decent, but it's not moving nearly as well as it used to. So we've got to find, those super, that's kind of like trading with your plan, having that strategy. And if that play follows in those guidelines, it's got potential to do that. Now, it's kind of funny when you look back at some of these people that are still on lease, LEAS. I mean, that's still got a 600 and 700 million float sitting at triples, or 0016. And they still think that's going to go to a penny. It's going to have to take all these other players in the OTC to want to all jump on that play to create that kind of momentum. Like I said, it has to be insanely strong interest to make these plays run as hard as they can. And share structure is a massive thing to look at. I'm going to go ahead and give you some example of share structures here. Well, here's one. Here's a really good one right here. This one's ran from 95 cents to 20. I think it hit $24.99 Friday. So from 99 cents to 24.99, that's 2,400%. But you're looking at this, it's got a 20,000 unrestricted. That means there's only 20,000 shares in the public float. Only 20,224 shares available for trading, period. I mean, there is no million, 500 million is the authorized shares for this company. The outstanding shares is 107 million. So they can obviously dilute, but these are restricted right now. It's a stop sign, meaning they cannot dilute. They have to find a broker, and brokers will not pull shares from their authorized share structure to put into their outstanding shares. Restricted are insider shareholders that are holding these shares under legal binding contracts. So they can't, these restricted ones cannot sell until their contracts are due or expire, et cetera. So that leaves only 20,000 available shares to the public for this stock. So like I was saying, stop sign, companies cannot find brokers that are willing to pull shares out of the authorized shares that they're given to dilute into the outstanding shares. It's very difficult. I can't really recall of any play that I've seen dilute. The only type of dilution I've ever seen was insiders bought a bunch of the public float and then were selling off their public float holdings into buyers coming in, and it looked like it was dilution, but it was actually public float turning over. So that gives you an example of share structure. That's a tight share structure. Now you start looking at plays like, here's a bad example, but I'm going to give it to you anyway. This play ran almost to, I think it was 3 cents. No, 2 cents. Yeah, it was a penny 90, something like that. Obviously, a huge amount of authorized shares, a huge amount of outstanding shares. Only 117 million are restricted. Unrestricted is 1.5, right at 1.5 billion in the public float, sitting at 0008. Now, that takes a ton of money to want to move that play, a lot, because it's at 1 billion shares in that public float. And like I said, seeing plays in the 000 sector right now with only 500 million or less in the public float, they're not moving a whole lot. They might be, some of them are moving 50%. You might get 100%, but that's like 000. DNRJ, that's one example. That's been the latest one. It ran to 150%. It's got a big AS, but it's got a lower outstanding shares, and it's only got 595 million in the public float. So it's literally a third of what we just saw on that last one. And it's taken a lot of volume. It's been a lot of hype lately. It's a lot of new DD on it. And it's moved from 0.0004 to, I think it hit 12 once already. But it's hard to say what'll move from this play. I'm getting a bunch of feedback here from somebody. So anyway, as I was saying, hang on, I've got to get this fixed. There we go. Nope, that's not it. Anyway, if y'all can hear me.
Yep.
Get feedback from somebody's mic. I'm not sure who it was. Okay, maybe it stopped. So anyway, dealing with that low volume, as I was just stating here for the summer, it's share structure is really the huge primary that I'm trying to focus on, because the tinier the share structure, the less influence it takes for that play to move in a potential gains position. So whenever I see a play pop up on Twitter or a play hit my scanner that looks like it's getting a bunch of dollar volume, immediately the very first thing I'm looking at is I'm going to OTC markets right here. I'm typing in that ticker name and I'm looking at security details as quickly as I can before I enter that play. And I'm seeing, okay, it's got a tight share. It's got a nice share structure for its price. So I'm automatically going to, go ahead and place a bid, especially if it's near a 52-week low. Your brokerage account will show you a 52-week low, or your scanner. Depends on your settings. So is near 52. It's funny. We've been seeing a lot of 52-week low plays, and DNRJ was a 52-week low play. Was at 0.004, and that's when it bounced off, and obviously created a bunch of interest. Right here. Created a lot of interest, and people are like, okay, this play is at a 52-week low. It's only got a 600 mil float. That's tiny for this play. Like I said, you look at lease, it's been trading at 0.0016 to 22. And you're dealing with a little bit larger float, but not much larger. And it's mostly people holding up that play for, lock the float pretty much. So whenever you see that, it's got a little bit larger float, and that it kind of fit my criteria that, okay, this play's got to bounce. Being at 0004, you just think of the upside, 100%, 200%, just depends on your, realistic price target. Bag holding. Why are you holding a bag? You think it's going to go to the moon soon. Why? The play has been dead for weeks, sometimes months. Why do you think it's going to make you well off, and your 50 to 80% red on it will magically come back? I never hold a play long enough to keep going red until it's so far down you think just one day you will profit from it. That's not going to happen. It might be years if you ever will break even. You take those funds out of that play and do some hard studying before placing it into another play. Your emotional mindset has caused you to marry it and fall in love with a toxic relationship. No bag is worthy of your everlasting love, giving it the hope and support of waiting on your outlandish price target to make you wealthy. Sorry to say, but a stock has no interest in the best interest for your account. So bag holding is really like a disease to your account. You'll have people that will hang onto these bags until death do them part, pretty much. And they're not letting go of it because, they start looking at when they entered it. Well, I had $20,000 invested in this play at yada, yada price. Now I'm down, 60, 80%, and it's worth this much. But the little percent, the little amount that it shows that I paid for it, it still has to reach that. And as soon as it breaks even, then I'll get out. It doesn't always work that way. You come to a play, and you've got to come to an understanding when a play is falling so hard or slowly bleeding, however it may be. You've got to take that money out. That money is still worth something. It's worth more than what it is sitting in that bag. So pretty much it's when I see that, you've got to pull that money out, sell it at the best possible price that you can during that next day or that week, or however you want to look at it. You put that money into another play going in the right direction. I mean, you could put it in a play that's priced around the same price. I don't care, but you take that money out. I mean, like I said, 60, 80%. You're sitting 60 or 80% in the red, waiting for what? Is this play ever going to go back up? Is it not? Very slim chance that it ever goes back up unless there's some dramatic, huge thing and there's a reason that it dropped and the share structure doesn't add up because maybe they diluted the hell out of it. So now the share structure is even larger now that they diluted, so it's going to take even more money for it to run again like it did its first run. The funniest thing I see sometimes as well is you all of a sudden have these Twitter groups. Let's say this play ran 400 or 500% in a matter of, a couple weeks. Lease, that's just a prime example. It's ran, a huge amount, and it's slowly made its way all the way down to a bottom. And all of a sudden, you got more interest in it again, and people, have locked it up and they bought it. Now they want to create Twitter groups. It's pretty much a bunch of groupies that get together and they talk about this play and all this potential. And it's like, well, it's ran already. Well, they're thinking since it went to nearly a penny, it's going to go to a penny again, just as likely. It doesn't work that way. I mean, it's so rare that plays rebound back to that descending thing unless there's something huge behind it that would give it so. Like I said, it's kind of luck of the draw sometimes, especially with lease that's been drug out so freakishly long and no progress has been made other than just the company just tweeting just to kind of keep those people happy. There's nothing substantial with it. Another one I've noticed lately is SBES. Yeah, it's affiliated with another stock ticker called ZMRK, but SBES ran to 0.0027. It fell all the way back down to 10-ish, I think, 0010. Which you look at that's almost a 200% descent. And, a lot of people are playing it. It's holding it. The share structure is right around the same size as lease. I think it's even larger than lease. It's around a 700 mil, I believe. But, not to say that it won't run. I mean, I'm not the one to say that it won't run. Oh, it's got a little larger. It's more like 800. But, I'm not the one to say that it won't run. So you pretty much got to put all these circumstances in it. Is it near a 52-week low? What's the chart look like? Like I said, right now with low volume, these plays will die or go even lower. So we've got to look at it before we just enter in it, just because some new DD has been found or Twitter stats or something. Okay, yeah, I remember then this thing was 0005, which was in March. And February is 0002. So it's obviously not bled out. It's pretty much locked up. And like I said, it's because pretty much these Twitter people, these strong followers in this play have pretty much locked the float to where it's not going to want to fall below probably 11. Looks like 11's been hit a few times, 3 times. So it might hit 11 again. Who knows? Looks like 9 is the time before that. And then obviously 6 and 5 the time before that. But it looks like 11 is obviously going to be the very strong support. 1, 2, 3. 3 times. Next was 13. That did hit 11 right there. No, that's 12. So anyway, you think about that as a perspective, what's the reason behind the play? Is there new exciting stuff coming out? And these plays will relive again. If something good potential drops, like I look at here in my filing scanner, let's just say a filing all of a sudden drops for that play. It's going to get my hopes up a little bit for the next day. But I have cash liquid. Like I said, it goes back to being liquid. You're out of this play because it's pretty much died down to its low for the time period. This filing has dropped. I'm going to go ahead and enter in for a quick day trade the next day because I've got cash liquid. I could throw in, 500,000, 15, depends on your amount of money you want to risk. You throw it in there, let it go up a good 20, 50, hell, 75 or 100% if it decides to, and you sell out or scale out in the meat of the move. The larger the position, obviously you want to scale out. So the whole mindset is to sell out periodically as this play continues to grow, and you got less and less shares, but you've got a less position to easily sell in case the stock decides to crash or falls back down to your entry, and you've obviously made profits from those shares that you sold during the meat of the move. If a play goes up and it has not, let's just say it goes up 10%, 15%, and I have not decided to start selling yet because it's such a low amount of percentage according to the position I've got in it, it comes back down to my entry. I'm starting to think I may exit near my entry because this play did not give the potential that I thought it would. But let's just say news dropped that very morning. And it went up 10, 15% and it stalled. I'm going to start thinking about selling because that news obviously was not strong enough to continue the momentum of that play. If I hold it for that whole day, I'm thinking about the next day. What's the next day going to be like? Well, that news is one day old. Is it all of a sudden going to catch a bunch of people's attention that evening or the next morning somehow and drive it up? Very, very unlikely. So the bigger the move, the more, the bigger the move, the closest to the freshness of that, that that drive that wants to bring traders to that one point of position or that one stock. You want to sell it near, the biggest move of that, the biggest meat of that move, according to how fresh that news is when it drops. So an example is HIPH. Learned it the other day. I think it was Tuesday, either Monday or Tuesday last week. I was expecting maybe a 50%, 30%. It's kind of what I was hopeful on it. Apparently, it only moved 10%. I think it was 5, 10, maybe 15%. And I was like, okay, well, that news, obviously, because it dropped that news that very morning. It looked good. It was good, strong news. But it wasn't strong enough news to bring in this low volume, the summer volume we're dealing with. And that share structure wasn't tight enough to create, that hopeful move. So like I said, you don't want to hang on these plays for unrealistic price target. You want to give it, sell it into the meat of the move that you can, and take your profits and go to the next one. You don't want it to turn against you, so to speak. So bag holding, it's a big no-no. My thing, you try to avoid these bags as much as possible. And just don't marry them, lose the bag. That money that you have could be liquid. It could be placed into plays that are running in the right direction, or you're getting in early because you hear rumor of strong news and the play's at a 52-week low. That's kind of what DRNG is at right now, in the stage that it's at, I should say. It was obviously at a 52-week low. It had a tight share structure. It all of a sudden created interest for people searching 52-week lows on their scanners. It was an easy entry. So you get in, it's got good share structure, and all of a sudden you have all these people come out on Twitter, new DD on it. It's just different ways or alternatives to help pump the play even further. We'll see how it plays out. I was kind of surprised it didn't pump out any further than it has for that share structure. But that's not to say the run isn't over yet. Never set targets too high. You're in this huge potential play because why? You did your research. It falls in line with your trading style. You've decided to set a price target. Price targets are dangerous. I set mental targets. I want according to the chart, but players that get any play at 0010 and claiming they're not selling till it hits 5 cents. Crazy math would probably say 2,000+% saying from that to 5 cents, just off the top of my head. They're gamblers to be realistic. Most plays on average hit a 15 to 30% gains. Few hit 100% plus, but extremely rare ones of one hitting 1,000% plus, and even more are rare. A person will ride it, and even more rare, a person will ride it from the entire way. So let's just say a person got in at 10 and he rode it to the moon somehow. It did supposedly go to 1,000%. It's pretty rare someone will ride it that long, because smart money is going to tell you don't be too greedy. You're going to take your profits off. And another alternative that I'll try to train for people is you can leave some shares in there, 30% of your initial amount in there if you want, and let that ride for free. And just see where it goes. And if it starts turning against you from its highs, then it's probably on its way down. And then you want to start scaling out of that. Common, a person will ride it up and all the way down to law. Okay, but it's even more common for a person. He will ride it up all the way and ride it all the way down to a loss, only because greed took over and their idea of the moon didn't meet their outlandish price target. Another incidence there. Let's say they did ride it up for so high, and they're promised the moon. It's kind of funny. The more tweets I see on a play, the more likely I've got to know in my head I've got to get out. The whole incentive behind people putting tweets in the first place is to draw more attention to it. Bigger followings are going to follow people that, put a lot of good stuff out there, and they're going to automatically, it's instinctively directing people to that play or causing interest to that play. So it's kind of funny. The more tweets I start seeing on a play, the more risky you're adding to yourself for staying in the play. It's not always a good thing that everybody in their, buddies are all tweeting this play, especially during intraday. I mean, it's one thing to be tweeting plays out on a Sunday afternoon, in the evening after hours. Pretty much people are getting, their stock picks interested into the other people to kind of see what they're seeing and see a potential moneymaker or play out of it. But if you see the same person tweeting that play over and over and over and over and over again on a continual basis, and the only ticker on their entire page is one ticker, they're just a one-tick wonder player. They have no interest in multiple players. They're pumping one specific ticker because they're trying to push this thing up further and further and further. And it's an automatic red flag to me. I mean, I want to be very careful of the play, as if you see tons of people tweeting during market hours on a play, this play is kind of reaching its toppy top, and people are trying to push it out there to see if it can get any more, or they're trying to sell into you buying the stock. That goes to talk about, I guess, probably my next thing here. I'm huge into studying people, watching traders, knowing how the human brain thinks. In OTC, you have to think ahead. Don't be a bear or a bull, but be a goat. Learn to hop from one trade destination to the next. The more traders start tweeting, pushing a play, the more I'm getting ready to sell or have already. Remember, don't be the last one holding the bag. Someone has to buy your shares you're selling. You have to outsmart the other traders in the same trade you're in. People all have their reasons as to why they buy when they do. Is it FOMO, which is fear of missing out, or is it if they know something, or is it just purely chasing the run? Be prepared to plan with every single trade. So sometimes it's good to have one plan. Sometimes it's good to have 2 or 3 plans on one trade. You want to think if it goes against you. If it goes up a good amount, is this your first target? Or if it goes up extremely good amount, is this your next target? How are you going to plan your trade accordingly? And don't let emotions plan your trade, I should say. I generally try to think a good mental structure. Sometimes I'll write it down as soon as I enter the play. And if this play kind of meets those criterias, I look at my paper and instinctively think, okay, that's what I planned for on this trade. I'm going to start selling out right there. It keeps on going. Okay, I'm going to sell out a little bit more right there and continue going. And I scale out my whole position and leave sometimes 20, sometimes 30% for it to ride free, because this thing has gone beyond my planned structure for the income I wanted off this play. Well, not income, but the amount that I expected it to move. So like I said, watching people, it's kind of funny. I will follow people on Twitter. I will have their alerts set up to where I get their tweets instantly. I kind of know what's going on. And companies behind their stock that have Twitter accounts. That's kind of a huge asset in a sense too. I mean, I get company tweets and I'll subscribe for their alerts on their tweets. And, as soon as they tweet, I instantly know, okay, it's going to draw a bunch of attention to this play. I'm going to go ahead and watch the price action real quick. And if it seems to be grabbing more people's attention, then you want to kind of play the play very carefully. If the chart is near bottom, especially, you've got good potential. But if it's already up a good amount, you want to be extra careful, because people will sell on news. People will sell on tweets. If the chart is showing that it's been accumulated huge over time, it's up a lot, and I'm expecting a sell-off. So something to think about. Watching people is a huge thing. It's kind of determining the next move. You've got to outsmart some of these players. Because winning in the OTCs is outsmarting the players, because you're selling your shares to the person who wants to think 5 cents a share probably on a 0.00210 stock. I don't know, but you got to play into the move. And that's why I like to do bottom plays, because I'm at the bottom. People have dumped. People have slowly let the stock just drop, have sold, whatever you may call it. They have their reasons that they got out. I've got mine because I'm at the bottom. I'm in it to ride it up, and I sell out according to people who want to chase it for FOMO or just got more intentions for the play because they see something I don't. It could be extra long-term due diligence that is coming out, or it's these people with outlandish price targets thinking such and such just told them about this play because it hit their scanners and it's up 100% already, and they want to grab in and think it's got another 100%. It's hard to say. Like DRNG, I got in at 4 or at 5 actually because I knew it was at the bottom. 0.004 was the bottom. I couldn't get it filled, so I had to slap the ask at 5 when it started getting thin. Thin meaning less bids on the ask, just a ton of people buying the ask up. So I grabbed my position and I wrote it up to 9 and then to 10, and that's where I sold it at 9 and 10. But you have those people that are buying it at 9 and 10 thinking it's going to go to a penny. It's going to go to multi-pennies. I don't know. And they instinctively buy it even though it's up 100+%. Sometimes you can do that. Plays will surprise me. They'll go up to, it could have went to 0015, 0020. Who knows? I mean, like I said, the share structure is fairly tight, but for summer volume, I don't see it doing that unless some substantial news really comes out and sways a ton of people to want to grab this play and do a Dave C style move, which was 1,000% that one day. Building the perfect master plan. This is a lesson I covered over a few weeks ago, but it's pretty much setting up a whole plan about your trades. So I'm going to go ahead and start it. Skill assessment. Are you ready to trade? Have you tested your system by paper trading? Some people want to do paper trading to kind of get a layout of how their trades work. And do you have confidence that it works? Can you follow your signals without hesitation? Trading in the markets is a battle of give and take. The real pros are prepared and they take their profits from the rest of the crowd who are lacking a plan. Give their money away through costly mistakes. As I was just talking about, who are you selling your shares to? It could be people making costly mistakes. They're FOMOing on the play. They're going to go ahead and buy the top of the play for that day because, like I said, it could be something they saw or something that told them to want to grab the play at the entry that they chose. A funny thing was BM Seaton. I know a lot of guys don't like him. We kind of make fun of him sometimes in the chat, but he's a big chart guy, so to speak. And he bought DRNG at 009. I think it was 0009. And he bought it. And I think about it, that play was up 125% at 009. What brought him to want to buy that play at 0009 up 125% already? Was it FOMO? Of course he's going to deny everything comes to FOMO, but is it, just the chart that just spoke to him that this play has so much more room left in it? Who knows? But he obviously had to sell out because I think he said he went to 10 and then he sold back out at 9 and 8 when it came down Friday. Because instinctively Friday evenings, you got to think about what are people going to be doing Friday evening? Are they going to be holding their play over the weekend, or are they going to be selling out to not hold plays over the weekend? Of course, the majority thinks they're not going to hold their plays over the weekend. Bad news could come out over the weekend. Anything could destruct their play for Monday morning. So pretty much my game plan is on Fridays, I'm going to be selling by noon, or I'm going to play some day trades up before noon, and I'm going to wait till that evening to grab some dip buys on good potentials, or because people will start selling them. So it's about outsmarting the majority of the crowd on these plays, because like we were just discussing early, 95% of traders lose on their trading accounts. So you've got to be that extra 5% to outsmart the competition. You've got to be able to trade a different style than what 95% of traders out there are doing right now. Mental preparation. How do you feel? Did you get a good night's sleep? Do you feel up to the challenge ahead? If you are not emotionally and physically ready to do battle in the markets, it is better to take the day off. Otherwise, you risk losing your shirt. This is a guaranteed to happen if you are angry, preoccupied, or otherwise distracted from the task at hand. Many traders have a market mantra they repeat before the day begins to get them ready. Create one that puts you in the trading zone. Additionally, your trading area should be free of distractions. Remember, this is a business, and distractions can be costly. So another way to look at stocks is cost of goods. You want to get your cost of goods as cheap as possible for your company, and you're going to sell it for a profit to, people wanting to buy the cost of goods at a higher price. Think of it as that way. You own this grocery store. You've got all this, fruits and veggies, whatever in there. You bought them at a cheap price at a discount from some dude in China. I don't know where you got them from, but anyway, you've got this cheap amount of, stuff, and you're trying to sell it to the markets that are coming in there, or the people that want to buy it for a higher price. So think of it as a business. When you're losing money on your merchandise, then, your business is obviously failing. You don't want to have a failing business because you keep selling your merchandise for cheaper just because the expiration date is starting to end on it. You got some rotten fruit sitting out front and you're just going to give it away just as cheap as possible. It just depends how long you want to hold that stuff for. So think of your trades as a business. And some people want to do yoga in the morning, go hit the gym, drink a good glass of coffee, an energy drink, whatever it takes to get you in the mindset to not feel angry. Let's just say you had a bad day the day before and you're still upset because you had a substantial loss or something the day before, the week before. Always prepare a new mental preparation for that day. Whatever happened the day before should not bug you the next day. Don't hang on to the emotions that have led you to, want to trade with emotions the next day, or revenge trade, so to speak. Never, never revenge trade. That's a losing battle any way you look at it. Set risk levels. How much of your portfolio should you risk on any trade? That kind of goes back to, trade sizes. This will depend on your trading style and risk tolerance. It can range anywhere from around 1% to as much as 5% of your portfolio on any given trading day. It could be more than that depending how small your account is. Sometimes you can be using 25, 35% of your account. I really don't suggest using more than that of your account if you're using a very, let's just say 5,000 or less amount. Don't use too much. That means if you lose that amount at any point in the day, you get out and you stay out. It's better to keep powder dry to fight another day if things aren't going your way. So sometimes you want to have a mental stop loss of 5% probably in OTC, sometimes 10, 15, 20, 20% of your original investment. 20% is really pushing it for me sometimes. If my entry is not at the bottom, but I feel strong about the company behind the play, then sometimes I'll average down to make that less. But whenever I get in a play, I never average up. If that's my position in the play, that's the position that's going to stand. If it starts running and I wish I bought more shares, it's pretty rare I'll ever average up or add some more in there because I'm adding that much more extra risk because it'll come down by the time I want to, buy more or sell more or whatever. So averaging up is a huge no-no for me. But if I'm at a very good entry, as I feel like I am, and it goes below my original entry, that's when I'll start adding a little bit more. But if I'm cautious of the play, let's say it's up 30%, something like that, and I'm cautious of the play, I'll put a 25 or 30%, position size, my ideal position in this play, a smaller amount. Let's say I want to put $5,000 in this play, but I'll go ahead and put 2,000 in it as a starter. That it seems like a good entry. I'll go ahead and put $2,000 in there. If the play drops a little bit more, I'm going to watch it really closely. If it drops even more, I may go ahead and put another $2,000 instead of selling it for a small loss, and bring my average down to, halfway between my last entry and my new entry. And that would be my average, is halfway between that. And then I'll leave that 1,000 on the table. If it decides to fall that even more, If it doesn't, then I'm in a good position for things to kind of roll on up. But I generally have a set amount I want to play in. But if I'm leery of the play, it's already up a good amount, then I want to put a starter amount in it, not my full position. Then I'm setting up for failure if it decides to come back down against me, and I could sell for a loss because I can't add any more money in it to average down, or it's not good to do that. It's adding too much risk. Set goals. Before you enter a trade, set realistic profit targets and risk reward ratios. What is the minimum risk reward you will accept? Many traders will not take a trade unless the potential profit is at least 3 times greater than the risk. For example, if your stop loss is $1 loss per share, your goal should be a $3 profit. So set weekly, monthly, and annual profit goals in dollars or as a percentage of your portfolio and reassess them regularly. So you've got to play the market to what it gives you, but that's a good way to put it. I never get into my plays unless I feel that reward is just, 1 times or 2 times greater than my, initial investment that I'm putting in it. That it's going to give me 30%, 50%, or 100%. In OTC, I'm generally looking for 100%. Any play I get into, I'm always thinking 100%. Some people want to think of it. Some people don't have to. That's up to you. Personal preference. But when I get into a play, I'm always thinking 100%. So if I'm at the bottom, I want to be sure I'm at the bottom. That gives me the best chance of my 100% that I'm hoping for. And everything fundamentally, everything on the charts, everything that associated to this play that's getting volume, it has potential to get volume because everybody's going to be looking at it. It's at a 52-week low or near it. They just dropped the filing that morning or the night before. Excuse me. Or there's something substantial that I feel like is going to come in for this play, and I'm going to be the first one in it. I'm going to be there early and see how this goes. Do your homework. Before the market opens, check what is going on around you. Planned plays. Have you done proper DD on the plays? Is there a mob of bashers talking about it? Do all your planned elements lined up for your plays? Have you checked the latest news for those plays? Besides anyone else telling you something, do you feel this is worth investing in? Plan your risk according to your found results. Going in light is never bad. Setting your proper homework. Think of it as a real estate property. Is this stock in the ghetto? Does it have bad neighbors? Is there massive maintenance issues? Is the foundation failing? Is this a quick flip or a long-term hold, as the market should reflect a higher value on your best judgment? We all value a dollar differently. Use common sense. Make sure you do your homework. Like I said, as soon as I see a play come up on the scanner or something is alerting it, or let's say the company dropped a tweet, automatically I'm going to go check to see what the share structure looks like. It takes a little bit of money to make it move. I'm going to go check the chart real quick and see how low this play is. Is it down here? Is it up here? Where is this play on the chart? Is there a bunch of volume down here, red volume or green? Does it look good potential to run even higher than where it's at? And I'm going to trade carefully in it. Sometimes you can go on Twitter, type in a quick tweet search here, look up the latest, and who's the last person to talk about this stock? What are they saying about the stock? I hate it when people use them as tags in their other tickers. So anyway, I go down, I start looking for this stock and what's the latest on it. Obviously 7 hours ago, but you look at intraday, what are other people saying about it? Is something good? All of a sudden, you're the first person on it. You see very few latest tweets. It's a good sign. You don't see very many tweets on it. You don't see a lot of latest tweets on it, but news just dropped on your scanner. You go to your scanner, you're always looking at it. You see news just dropped on it. It just shows this announces a $4 million private placement at quarterly production of 100 EV stars. So all of it automatically, you can pull that news up, do a quick scan on it real quick, kind of look at the details, make sure everything looks legit, yada, yada. Okay, looks at it, goes back to your broker, see if there's gotten any volume in it real quick, and you can pretty much get in as quickly as possible before any others start noticing it and all of a sudden start blowing up Twitter with it. So automatically I'm going to be looking at my scanners. I'm going to be looking at, the share structure, what's related to this play. It's kind of a quick DD, so to speak. But after you're in it, you can play the move. And if you want to hold it longer, that's when you can start digging in further behind the company and, go to the company profile, start looking through the filings, start digging through their last filing, do some research on the CEO. You want to kind of check behind the background of this company and, what's their financial state. But yeah, look at them. You can pull up their website, see what kind of legitness there is going on with this company. But you can kind of do that while you're letting the play do its thing, and you've got a good entry because the chart told you so. Okay. So do your homework. Trade preparation. Whatever trading system and program you use, label major and minor support and resistance levels. As I kind of got listed here, this is my minor and major support resistance levels as my red dashes here. This is the lows. This is the lows. That's the highs. That's the highs. So automatically when I look at my chart quickly, I'm going to know that this is the last support. The last support range is 11. Let's say the price is at 12. I'm automatically thinking, okay, it's low. It's near support. News just dropped. I'm going to grab a position because it had a high of 21 right here. Hell, it had a high of 27 right here. So I've got that upside from 11 or 12 as the current prices to see 100% when it goes to, let's say, 24 to 27, 21 to 27. I would get my 100% somewhere in that range. So let's just say 75 to 100%. I've got my selling target. Obviously, 22 is a resistance. 21 is a resistance. It's at 12. So if it hits 21, if the strength looks weak, I'm going to be selling near 21. If it seems to look strong and power through it, then I'm automatically going to be thinking a little bit less below 27, probably 26 or 25, because other people's brains, other people's minds are thinking the same thing. So are they going to be selling at the top, or are they going to be selling just below the top? You want to sell it before other people decide to start selling it. And you don't want to be selling as this place starts downtrending all of a sudden because the news is old or the news is just not interesting enough anymore. And as lower volume has caused in the markets lately is news doesn't last long. Sometimes it lasts a couple hours, it seems like, and it's frustrating because you want to, you got in this play at a good price and you want it to go to the moon. We always want these really big price targets, but we got to take what the play gives us. Whatever trading system and program you use, label major and minor support resistance levels. Set alerts for entry and exit signals, and make sure all signals can be easily seen or detected with a clear visual and auditory signal. So this is a clear signal to me. Sometimes I will put on my E-Trade app. I use my phone for buying and selling. But on my E-Trade app, I have a little section there where I can put alerts for that play. Let's say the price hits a certain price target. It's going to alert me. So if I'm going to put my sell alert between 21 and 27, I'm automatically going to put my alert at 20. As soon as that stock hits 20, it's going to alert me. And then I'm going to go look at my chart real quick. And the level 2, is this play looking strong? Is it looking like it's going to break through that 20, that 21? If not, I'll go ahead and start selling at 20 and 19 probably. And still made a decent profit from my 12 to 19 and 20. Set exit rules. Most traders make the mistake of concentrating 90% or more of their efforts in looking for the buy signal, but pay very little attention to when and where to exit. That goes back to back holding. If you don't plan an exit, you're going to end up back holding this play or have no strategic strategy of selling this play to other market buyers. Many traders cannot sell if they are down because they don't want to take a loss. Get over it, or you will not make it as a trader. Your mental stop gets hit from your emotional panic. It means you were wrong in your mind. Don't take it personally. Professional traders lose more trades than they win. But by managing money and limiting the losses, they still end up making profits. Panic loss can be another buyer's dip, so please judge respectfully, as we all can be wrong on a trade not going our way. Factors are dilution, insiders dumping early entry trades, profit taking, or someone knows bad news and people are, as a group, follow the action. So let's just say I put out sell alerts. Imagine if I put sell alerts on every single play we did. What would happen? I tweeted it. Oh, I just decided to sell this. This play does not look strong anymore. I suggest everyone get out. it's going to cause a bad vibe for all these other people that are still in the play, wanting that extra, that extra amount that it could easily give. So if you're a bullish trader, instinctively, you're going to think bullish for the play. You don't want to obviously cause a bunch of bad vibes or bad incentives on the play. But I'll give my take on it. If this play is obviously descending, it's obviously dumping, and there's obviously some bad situation that it's obviously caused for itself, not for my suggestion or for other people's suggestions that follow them closely and are going to want to sell as soon as Magic Mike sells. I'm going to sell as soon as he says he sells, and everybody follows, and everybody is just going to destroy the play or the momentum of this play. So we got to sell out according to what our plan is for that play. I can't be alerting as an individual for the group. If you understand my take there. Be prepared mentally for anything. Always think of your exit plan. Taking profits is too early is much better than panic selling into the bid. As a rule, I never re-enter the same play. I mean, it's not all the time I don't, but it's pretty rare I ever re-enter the same play unless it's much cheaper than my last profit-taking exit. That is the only time I exit. That is the only time I enter again. Is, let's say this play ran up, I sold. I'm not going to chase it again or play it again, even though if it continues another 25, 30% above my last exit. But if it comes back down to where I exited last time and it looks like it hit a support line, then I'll probably enter again for another quick day trade. There's endless other plays that cross their paths. So don't just take it all on one play just because the majority of momentum is wanting to play that play. Before you enter a trade, you should know where your exits are. There are at least 2 for every trade. First, what is your stop loss? If the trade goes against you, it must be written down. Second, each trade should have a profit target. Once you get there, sell a portion of your position, and you can move your mental stop loss on the rest of your position to break even if you wish. As discussed above, never risk more than a set percentage of your portfolio on any trade. After a play has made a big run, sell your initial investment, let free shares ride as that's your profits doing its thing. Manage it accordingly, but at least you got your money back while your remaining shares are working for free. I think I got a calculator somewhere in the chat room where it shows that you can sell 30% of your shares when the play is up 30%. Another 30% of your shares, which would, another 30% of your remaining shares at 50%. And then you can sell 40% of your shares I think, or 40% of the remaining amount at 100%, I think. I need to go back and look at that. But anyway, I'll go and pull it up, actually. It's right here in the calculator. Oh, wrong calculator. Got 2 here. That's that stock average calculator. Yep, this one right here. 30, 30, 40 exit strategy. So pretty much you've got, let's just say 1,000 shares. Your average price is 0.0 or 0.05. It's going to calculate that 30% at 30% profit, 300 shares at 65, 30% at 50. Oh, this is a tiny amount of money. Let's try 100,000 shares. So 30% at 30% profit. You're going to sell 30,000 shares when the price hits this price. It's going to cost you that much. That's that much profit on the table. 30% at 50% profit. That's another 30,000 shares at 0.0750. Now you got $750 profit on that remaining amount of shares. Then you're going to sell another 40% at 100% profit, and that's going to give you 2,000% profit, leaving you a total of $3,200 in profit off of that 100,000 share when the price went from 5 cents, meaning it went 100%. Not every time does it go up 100%, but you're scaling out as this play goes up. So you're selling your profits as they go up. So let's just say you sold out 30,000 shares, you got a $450 profits, and it didn't seem to want to break 650. Then you could start selling out a little bit more if it's not going to seem to break 650. But if it does continue, you can go up to 750. You still got more profits on the table there. So this calculator, I've got it linked right in here. It's on the calculator section on the Magic Team area right underneath your gold or your elite channels. This one right here is an average calculator. Let's just say never actually used this thing. I think someone else wanted this posted. But this is obviously, it's an average calculator with the purchase price. Just say we bought 100,000 shares, 0.02. 100,000 shares. We bought another 100,000 shares at 0.01. That's going to give us an average of, oh, I've got to put a point in here. An average of a penny and a half. So that gives you an idea of what you're dealing with there as an average down calculator. So that's another helpful tool right there. It makes it good for everybody. So set entry rules. That's after exit rules, setting your exit rules. Set entry rules. This comes after the tips for exit rules for a reason. Exits are far more important than entries. A typical entry rule could be worded like this. If signals a fire and there's a minimum target at least 3 times as great as my stop loss and we are at support, then buy X contracts or shares here. System should be complicated enough to be effective, but simple enough to facilitate snap decisions. As I was talking about, the first thing I go look at is share structure. What makes you snap at the decision to make a play real quick when you see an alert, or you see something potential on your scanner pop up with some dollar volume or some buy volume or some percentage jump. So set some entry rules of, look at your guidelines and make snap decisions in order to want to buy that play. Should be complicated enough but effective, but simple enough to facilitate snap decisions. If you have 20 conditions that must be met and many are subjective, you will find it difficult, if not impossible, to actually make trades. At least good entries for your trade. So if you got 20 conditions with a ton of 20 different guidelines this play has to meet in order to get them to play, then it's kind of tough when something hits the scanner or something looks potential in your intraday alerts or your intraday stocks that you want to play. I mean, sure, why not do 20 conditions if you want to find a play, that ran Friday and you want to looking for an entry. Sure, why not use a bunch of conditions on a Sunday or Saturday to reveal this play during non-market hours and then determine your entry for it then. That must be met, and many are subjective. You will find it difficult, if not impossible, to actually make trades. Computers often make better traders than people, which may explain why nearly 50% of all trades that now occur on the New York Stock Exchange are computer program generated, such as robots. We've got a lot of computer generated robots for these plays, which I could show you how a robot works here in a minute if you'd like. Computers don't have to think or feel good to make a trade. If conditions are met, they enter. When the trade goes the wrong way or it hits a profit target, the exit, they don't get angry at the market or feel invincible after making a few good trades. Each decision is based on probabilities. Never chase. Be careful of market makers' manipulations on morning gap ups. I never chase gap ups if I can help it. It depends how strong the news is, but if it's got, let's just say mediocre news and market makers are gapping this sucker up way up, then I'm just not going to chase it. I'm going to wait till market opens, going to see how it, because every gap up always brings it down a little bit of something in the morning. So as soon as market opens, it generally comes down to a certain point. Then you can try to buy in if you really feel strong about this news and then go back up. But you got a lot of people that set, market orders at opening bell before the bell opens. They got orders set in, even though it's gapped up a ton, they keep adjusting to the gap. I'll sometimes do that only if that news is very strong and we're in maximum volume time period, which was like January, February, March, that area. I was actually doing some of that because it really paid off to get in early on some huge couple 100% runners that way. Always look for the best possible entry on a support line. Buy when people are dumping a good play, kind of like our TPNI dump we had that other day or a couple weeks ago with Ball and his group panicking because they kept slapping the ask and they wanted to dump the crap out of this play. We bought at 9 and 10 and the play rebounded back to 15. That's 50% gain right there. And you think it's based at the bottom. I enter, then sell when a bunch of people start really noticing it and it's taking off. Let free shares ride. Outsmart the basic trader. Start outsmarting your competition. Keep excellent records. All good traders are also good record keepers. If they win a trade, they want to know exactly why and how. More importantly, they want to know the same when they lose, so they don't repeat unnecessary mistakes. Write down details such as targets, the entry, the exit of each trade, the time, support and resistance levels, daily opening range, market open and close for the day, and record comments about why you made that trade and lessons learned. So writing a diary of your plays, so to speak, it can be very helpful to, because you're implementing it in your mind. Let's just say you're a brand new trader, you're trying to learn these skills. You want to sometimes write this down and implement it in your mind to know what went good about that play or what went bad about that play. And when you start seeing another play have similar actions or similar, circumstances according to how you're playing it, you automatically think about that other play that either hurt you or did really well for you. Sometimes I don't forget ticker symbols that really left an impact on me, especially the bad ones. Those leave a bad impact on me. So I don't forget them. Also, you should save your trading records so that you can go back and analyze the profit or loss for a particular system. Drawdowns, which are all amounts lost per trade using a trading system. Average time per trade, which is necessary to calculate trade efficiency. So let's just say you did some quick trades. You want to write down the time period that you bought and the time period that you sold. Sometimes it could be weeks, months. It's pretty rare I ever hold something for months on end unless it's something, it's a good swing play and I'm holding it for much more long-term, and I've done my due diligence on it. Everything adds up. It fits my 50, restricted, specs that I want this play to meet before I want to go long-term on it. I mean, it's got to fit every freaking criteria before I ever do it. And other important factors, and also compare them to a buy and hold signal or strategy. Remember, this is a business and you are the accountant. Perform a post-mortem. After each trading day, adding up the profits or loss is secondary to knowing the why and how. Write down your conclusions in your trading journal so you can reference them later. So after each trading day, adding up the profits or loss is secondary to knowing the why and how. So that's kind of like I was talking about there, writing it down in your conclusion in your trading journal so you can reference them later. The bottom line, successful paper trading does not guarantee you will have a success when you begin trading real money and emotions come into play. I've never really done any paper trading, but when you do it, to me, instinctively, I'm thinking it's not really using my emotions unless you're some kind of weird guy who's really emotionally attached to every paper trade. But it is a good source to kind of help new people that don't want to use real money. For me, the best decisions that ever worked for me was using real money because I'm more involved with that trade. I'm more afraid to try to lose my real money and make sure that I'm successful in every trade. And like I said, it is more riskier, obviously, but it trains you in a good way to learn the hurts and the goodness of a trade. But successful paper trades does give you the trader confidence system they are going to use actually works. So when you have good paper trades, obviously you feel like you've got this and you can use real money and everything's going to work out great because every one of your paper trades are making good money. The bad thing about paper trading is it's not actual live order execution. So let's just say a play decide to bounce around between two digits. And you were trying to get the bottom digit with a full order. Paper trade automatically it's going to execute the whole dang thing. But in real life, you're going to get whatever shares get dumped on that bottom digit before it goes up. So realistically, your paper trade isn't going to be accurate when it comes to bouncing between two digits and you're trying to get the cheaper digit and you're going to execute whatever the shares of your full position it's going to give you on a live account. Deciding on a system is less important than gaining enough skill to make trades without second guessing or doubting the decision. There is no way to guarantee the trade will make money. The trader's chances are based on their skill and system of winning and losing. There's no such thing as winning without losing. Professional traders know before they enter trade that the odds are in their favor or they wouldn't be there. By letting their profits ride and cutting losses short, a trader may lose some battles, but they will win the war. Most traders and investors do the opposite, which is why they never make money. Traders who win consistently treat trading as a business. While it's not a guarantee that you will make money, having a plan is crucial if you want to be consistently successful and survive in the trading game. So that pretty much covers my conclusion for today as far as my class, my lesson. I'm just kind of wanted to give you the lay of the land here. I know we got a lot of new people in the room now, and I hope this was very beneficial for you guys.